What's going on, Wealth Builders? My name is Charles Newton with Secure Harbor Financial, and in this video, we're going to break down the anatomy of a whole life insurance policy. We're going to talk about how the base works, how the paid up additions, also known as PUAs, work, and how the term riders work within the policies, and the different correlations and considerations that are important to know about when getting one of these policies. And beyond that, we're actually going to show real life illustrations and the different policy designs. We're going to break down how those things work. So we're going to apply the concepts that we're learning from the anatomy. We're going to actually see that in the actual illustration so you have a better understanding of how these things work and so that you can make a more informed decision. All right, so let's jump right in. So let's break down how whole life policies are designed. So we have the base portion, and just so you understand, the base portion is the foundation. Think of it as the foundation to the house. Okay, so you have the guaranteed death benefit, you have the cash value growth, and you have the fixed premiums. Now, if you're gearing a policy towards 100% base, and we'll explain this in an actual illustration if you keep on watching, but if it's 100% base, you don't have any flexibility, but you've increased your death benefit. Now, let's talk about how paid up additions are the fuel to the cash value that really accelerate that whole cash value. So here we have paid up additions. Paid up additions actually increase your cash value, and they also increase your death benefit at the same time. So if you're looking for a policy that has a higher cash value percentage in the beginning years, then you have a higher percentage, then you gear the policy towards a higher percentage of paid up additions, and you reduce the percentage of base. So that base is the foundation. However, the paid up additions is the supercharging of your cash value. So when we're looking at early cash value policies, we want to have more paid up additions. Now, it's also important to note that as you veer away from base, as you have a lower percentage of base, and a higher percentage of PUAs, you need to stack on what's called a term rider. And that term rider gives you additional benefit for a fixed period of time, anywhere from 7 to 30 years. Now, when you're doing that, you have to understand that there's what's called a modified endowment contract. And it's important to understand that if you didn't have that term rider and you were to try and overfund the policy or fund the policy for maximum cash value, what would happen is the policy would MEC, or also known as a modified endowment contract. And what that means is that the IRS would no longer give you tax favorability for these policies. Okay, so therefore, my goal as an agent is to build the policy so that your cash value just hits the ceiling of the modified endowment contract, but does not exceed that, so that you get maximum cash value if that's what you're looking for. If you're looking to do maybe like the be your own bank strategy or something like that, this is how you design the policy. We'll show an illustration, an actual illustration of what this looks like in real life. And just so you guys know, with the modified endowment contract, there's also a 7-pay test. They work hand in hand. The 7-pay test is how much you can maximally fund your policy without it mecking for 7 years. We'll show what that looks like in an actual illustration coming up. And we're going to briefly go over policy riders. The base is the foundation. The paid up additions is actually another rider, and the term portion of the policy is another rider. Those are the main portions of a policy. But we have what's called a waiver of premium. And what that does is if you ever became disabled, what would happen is the insurance company would actually continue to pay the base portion of your premium, which I think is huge. And there's also an added expense to that. So you got to weigh the pros and cons. There's also what's called accelerated death benefits. Now, these accelerated death benefits, whether you're chronically, terminally, or critically ill, you could actually have access to the death benefit, which is an amazing strategy. And if you're not the biggest believer in Western culture and wanted an alternative medical treatment, you would have access to that money to do so. And then on top of all this, you can add what's called a long-term care rider. Now, there is a huge issue in America right now with long-term care. It's an extremely expensive service to have long-term care. It can be up to over $120,000 a year. And with this whole life policy, you can stack on a rider that actually gives you access to the death benefit to pay for those expenses while you're alive. On top of all this, you can do what's called a child term rider. And what that does is it gives your child a death benefit as well if something were to ever happen to them. One thing to consider with these policies and the flexibility of these policies is after 7 years, you can do what's called a reduced paid up policy. And what this does is it would say, you know what? I know this policy, we were expecting to pay till age 65 or 75. However, we have a cash flow crunch and we want to turn the policy off, but we want it to continue to grow and to stay in force. Therefore, you do what's called a reduced paid up policy. What that would do is it would reduce the death benefit, but at the same time, you'd still have access to the cash value, you'd still have a death benefit, and it would continue to grow according to the dividends throughout the rest of the policy life. And as long as you're alive, it would just continue to grow from there. It can be a very powerful strategy. In the illustrations that I'm going to show, I actually do a reduced paid up at year 7. So you can see how these things actually work in real life. And it's important to note that when you do a reduced paid up, most companies will actually waive the other riders that you have within the policy. So it's important to weigh those different factors when making these decisions. Anyways, let's hop into actual illustrations, and we're going to show you 100% base and see what that actually looks like in real life and why Dave Ramsey and Susie Orman hate these products so much. All right, so here it is. This is the reason that Dave Ramsey and Susie Orman hate whole life insurance policies. This is the reason why. Okay, so right here we have a 100% base whole life policy, okay? And this policy has been funded for 7 years at $142,857 for 7 years. Now, the reason I'm showing this is because I did another video on hard money lending, and I gave the example of somebody that wanted to fund their policy and put $1 million in over the course of 7 years. So I'm just keeping that going. You can watch the video right here if you'd like to. But anyways, let's dive into this policy right here. So at years 1 and 2, we've put in $142,000 each year. And look at right here. We have no cash value. We have a death benefit of $10,341,000. So as you can see here, when we're doing an all-base policy, it's geared towards the death benefit. And the problem with this, and the reason that Dave Ramsey says putting your money in a whole life insurance policy is like putting your money in a black hole. This is the reason why. The first 2 years, you put almost $300,000 in and you have no cash value. I can completely understand why he says that. I'm not saying that these policies are bad. This policy is designed for somebody that wants to have legacy. This policy is for somebody that already has a lot of cash flow and a lot of liquid assets, and they're not focused on the cash value aspect of the policy. They're focused on the death benefit and the legacy that this provides. It's important to note that this policy isn't bad. It just might be bad for the person that is looking for an emergency fund, an opportunity fund. So I just want to illustrate at year 19. If you look here, this is the break-even point of this policy. You put in $1 million over the course of 7 years, and it took until year 19 for it to break even, which is why Dave Ramsey calls this the black hole, right? And I just want to note that the reason that we're only paying to year 7 is we did a reduced paid up right here. And like I said, we were doing a hard money loan example. So we're going to break down how these policies are not necessarily flexible. So when you have a 100% base policy, you can't deviate from your premium. The minimum required annual premium here is $142,857. There's a lot of rigidity in that, and that creates a problem for a lot of people because everybody's cash flow can be different year to year. And I just want to note that the 7-pay premium for the policy is illustrated is $456,000. So as you can see, this policy is not efficient because there's around $300,000 that can be added towards the cash value using PUAs within this policy. So let's hop into an optimally funded policy that's highly efficient and has high liquidity in early years so you can have a better understanding of how these things actually work. All right, so now that we know what a 100% base policy looks like, let's take a look at a completely different design policy, how it actually performs. And I just want you guys to note here, look at this contract premium. This is the exact same premium for the exact same time period for the 7 years. Remember, we're using this example for that hard money loan example. And so same $1 million over the course of 7 years. In year one, this gentleman puts in $142,857. And after the first year, he has access to $130,365, which is around 92% liquidity in the first year. Remember on the last 100% base policy? For the first 2 years, that was 0%. They had zero access to money for the first 2 years. So this is the kind of policy that we're talking about when we're talking about a high cash value policy. Remember, in the 100% base policy, our break-even point was year 19. In this policy, our break-even point is between years 3 and 4, right here. This policy is extremely efficient. You have early access to cash value, and it continues to grow uninterrupted tax-free for the rest of the policy life. Now, I want to break down the flexibility of this policy. So the way this policy is designed, the minimum required to contribute to this policy to keep it in force for the year is $13,000. And the maximum that you can fund this policy within the 7-pay is $163,000. So there is maximum flexibility with this policy. Now, I just want to break down the different factors and the considerations of this policy. Remember how we have the base, we have the term rider, and we have the paid up addition. So we're going to break all that down right here. So this policy is a 50% base, 50% PUA blend with a 7-year term rider of $1.725 million. You can see the costs and everything broken down right here. So the way that this policy works and the flexibility that's baked into this policy is we have the floor of $13,000, we have the maximum fundability of $163,000, but the reason that we can fund this policy the way it is according to the single premium PUA rider. So in the first year, we contribute $143,000, and we continue to fund that for the next 6 years after. So for a total of 7 years, we fund the $143,000, and that's the flexibility baked into it. When you consider the 7-year term rider, which you can see the expense here, and you can see the PUA rider, which you can see right here, that's how these policies are designed. And so it's really important to understand that there's a lot of flexibility that's baked into these policies, that can be baked into these policies. And the reason that I like creating the flexibility for most people that I work with is because we don't know what future cash flows might be. So when I'm thinking of a strategy, I want to make sure that that strategy is going to last a lifetime and not just a few years and then everything crumble. These are all important considerations, and it's important to work with somebody that knows and understands these different caveats and also has your best interest in mind. All right, so with this illustration, what I'm looking to do is show you the flexibility and how we can structure these policies. So with this example, this is the same $1 million of premium in the first 7 years. It's just distributed differently. So in year one, as you can see right here, there was a dump in of $500,000. And after that, after the first year, we have a net cash value of $462,000. That's a 92% liquidity in the first year. We're showing how compared to the 100% base policy to this policy, how much more cash value we have access to. This is how, a hard money lender could almost immediately deploy the money that they put into this policy. They could put that money back to work in their hard money business, like in the example that we showed in the other video. So I just want to illustrate that the break-even point within this policy is between years 4 and 5. So it's highly efficient. And I just also want to note that at year 7, we still did that reduced paid up. But as you can see, this policy, the net cash value, and the death benefit, they continue to grow, even though this policy is no longer funded for the rest of its life after year 7. So let's break down the flexibility within this policy. So if you look right here, we see that this is a 40% base, 60% PUA blend for how this policy is designed. And then we also see that we have a 7-year term rider for $5.175 million. And the reason that we need such a large amount of death benefit is so that this policy doesn't mech. Remember that whole mech thing we talked about? So if we look right here, we can actually see what the policy would mech at. This is how efficient this policy is. In the first year, we put $500,000 in. If we put just $579 more, this policy would mech and it would no longer receive the tax benefits. So when I say that we're trying to design the policy so that the mech limit just hits the ceiling but does not exceed, this is exactly what I'm talking about. But just going back to this policy, we can see how flexible these policies can actually be, how much liquidity we have, and how they just continue to grow on a very predictable basis. That's the magic behind utilizing the strategy in your life. Look, I know we covered a lot of information with this video. We talked about the different anatomies. We looked at different actual policies, illustrations to kind of really illustrate and drive home the different concepts that I was trying to convey to you guys. If you still have questions, I'd be happy to hop on a call with you and give you guys some clarity. And be sure to like and subscribe to help the algorithm out. I appreciate you watching to this point, and I look forward to serving you in the future. Thank you.